Welcome back, y'all. Thank you guys so much. If you haven't already checked it out, Facebook is actually one of my, or I guess really Meta, is one of my current biggest holdings, and it's one that I really want to track here on the channel, and I figured let's just go over their Q4 earnings. If you haven't already seen my previous video, it should be somewhere up here. I don't know where it's going to end up. But check the card up in the corner, and then you'll be able to see where my Meta is. Then this is kind of updating it, and at the very end of this, I'll throw in a DCF of what I think Meta is currently worth today. And also, if you're interested, I'll link it down below, the DCF and all that stuff. So just let me know. But today's video is basically going to look like this. And if you want to jump between the parts, I'll leave timestamps down below as well. But basically, we're going to talk about Peter Thiel and why he left Meta. We're going to talk about the metaverse and just sort of what the risks are as far as what came out for their 10K. We have the CFO commentary for the quarter, and we also have the financial statement review for the quarter. The ARPU information, Mohnish, Pabrai, and Sum Zero did an interesting interview. I got to listen to half of it, but I'm just going to kind of generalize with David Park's tweet. You'll be able to see what Mohnish's actual idea is on it. The Google privacy changes, if you haven't already seen that, and then obviously the intrinsic value at the very end. So let's hop right into it. So if you haven't already seen it, Peter Thiel is actually going to be leaving. I believe this article came out around the beginning of February, so February 7th. Peter Thiel is actually going to be leaving, and I believe that what he is going to be doing is focusing on the midterm elections. At least that was what was cited. I'm sure maybe there's some other things that are in that, but Peter Thiel was obviously a big investor. It's a big person to have on your board, and for him to leave, it's not something to be taken lightly, but I think that he feels confident in Mark Zuckerberg and the rest of the board of directors and the rest of management to actually run this company well. I don't think this is going to be the biggest hit to the company, especially if what they're saying is true. So if he's trying to back the midterm elections, then more power to him, really. So that was just a little interesting tidbit. But again, Peter Thiel is a pretty big investor to have leave. So it'll be interesting to see the next year and a half, 2 years, what that actually does. The next thing that I wanted to talk about was actually the quarterly and fiscal 2021 review, just because this is the first time that they've actually broken out the family of apps and then the Facebook Reality Labs sort of thing. And I think that overall, I'm not disappointed in these earnings. I really am excited for the potential at what this company can do with the Reality Labs. I'm not banking on it, and honestly, my whole calculation isn't banking on the fact that Reality Labs is going to be this huge success. If Metaverse is a big success, then I'll just take it for free. But I'm really focused on the advertising revenue because I think it's where the money is. But as far as how they did a 20% year-over-year difference on their Q4, and then obviously a 37% fiscal 2021 compared to fiscal 2020. And then obviously, their EPS on the year is roughly 36% as well. So it's good to see that you see that trending up. You don't see any weird sort of changes, because every so often, if net income's going down but revenue's going up, that means they're spending a lot. And we'll talk about what they're spending on the metaverse here in a second. But the only other thing I wanted to mention was just here's how you can see the actual breakout now. So you have the advertising revenue and then the other. So this is all their sort of miscellaneous items that they have, but they've actually broken it out now. So you have family of apps. That's going to be your Instagram, Facebook, WhatsApp, any of those sort of platforms that they have. That's what's going to fall under family of apps. Then Reality Labs, it's going to be your Oculus, your Quest, anything that's going to be involving the metaverse, it'll all fall under this. So if you can see year over year, they've gone from, what is that, around 500 million to about 2 billion. So that's pretty good gains. Nothing to write home about. This is really what we're going to be talking about here today, is they've lost $10 billion on the bottom line in terms of reality. So the total net income that they would have had for the year has been decreased by $10 billion that they've been putting into Reality Labs. And I'm not surprised, they got to do a lot to really put R&D into this. But for them to have a 10 billion loss, that's something that people are worried about. And that's kind of why you saw this huge drop come from Facebook. So I just wanted to hop on over to the chart real quick, just so you guys can actually see where we're at. So in, what is this, around September September, October, we were at about 370, 380. That was kind of the 52-week high. And then as soon as they released earnings, you said giant red candlestick down. As soon as they released those earnings, we saw a huge drop. So now we're at around $207 as of making this video. So we went from, what is this, 320, 330, all the way down to 200. So about $100 per share is currently gone in less than a month. That's pretty crazy. That's honestly pretty crazy. The other thing that people were concerned about was the CFO's commentary. On the impression side, we expect continued headwinds from both increased competition for people's time and a shift of engagement within our apps towards video services like Reels, which monetize at lower rates than feed and stories. This also goes on the fact that they're trying to compete with TikTok. They mentioned in their 10K as far as their competitors go, that Reels is really what they need to monetize because Reels is trying to compete with TikTok, and it's going to be real hard if they can't keep up with TikTok's platform. The other thing that they mentioned was they're estimating the first quarter come in at around 27 to 29 billion as far as revenue goes. That'll be about 3 to 11% depending on the growth. Obviously, people are concerned about the growth now. Is this switching to a value stock? Is this, moderating a lot? That's what people's concern is right now, and that's totally fine. And then obviously on the pricing side, we expect growth to be negatively impacted by a few factors. First, we'll lap a period in which Apple iOS changes were not in effect, and we anticipate modestly increasing ad targeting measurement headwinds from platform and regulatory changes. Second, we will lap a period of strong demand in the prior year, and we're having advertisers macroeconomic challenges like cost inflation, supply chain disruptions are impacting advertiser budgets. Now, I don't know if you know anyone that works in social media or works on ads. I know a couple people, and they have been echoing this, and their companies have been echoing this, that they've had to cut down their marketing budget just because of the general economics of their own business. So it'll be interesting to see when the supply chain sort of clears up, and I don't know if it'll necessarily go back down in terms of the prices and things and costs of things as far as doing business, but it'll be interesting to see, when people have access to these items more, what that'll actually do. Now, obviously, their total expenses is around 90 to 95 billion for 2022, and their prior outlooks are 91 to 97. So they raised their expenses a little bit, and this is obviously probably going to be due to just building out their sort of employment base, their salaries, and then obviously all the R&D stuff that goes into the reality labs. Now, the other thing that I wanted to point out is on their presentation, you had your revenue and how it was broken out. You can see all the different quarters and really how it's all broken out. Again, US and Canada are going to be coming in the hottest. Then you obviously have Europe, Asia Pacific, and then the rest of the world. And if we can break this down by average revenue per user, where is it? So the family average revenue per user is at about $9 now. And obviously you can see it's been increasing year over year over year. And there's obviously this seasonality of this business and how well it does. But really, a lot of people became concerned because you see going through the last couple of quarters, we've had these users grow and grow and grow. And then this is on the daily active users, we saw a slight decline. Again, we're at 2 billion users. You're hitting a saturation point where the majority of the people who have internet, who have smartphones, are pretty much on it. Obviously, we'll see as the rest of the world kind of comes online and gets access to this stuff, what that really does. But I mean, at some point, this can't grow exponentially forever, and you've seen it kind of moderating over the last couple of quarters. So that's not really that surprising at all. And then again, the average revenue per user based on the geography. The US and Canada obviously going to have the highest average revenue per user. And again, I said this in my last video, and I think it still stands true. I think if they can increase their average revenue per user in Asia Pacific and then just the rest of the world, I think that they'll have a better chance at competing and really holding those margins strong, because again, it's really hard to compete against someone that has 2 billion users across all of their platforms. It makes it really difficult. So that is definitely something that you want to pay attention to, though. You want to make sure that their ARPU is growing and that they're able to monetize their users that they currently have. Now, if you haven't already paid attention, and if they haven't uploaded the interview yet, it was on Zoom and on Twitter Spaces. They'll upload some zero here. We'll upload this around next week as of putting out this video. But basically, David Park summarized Mohnish's points. And Mohnish really talked about how Zuckerberg and management team like to make big bets. They like to bet on one thing at a time. They're not necessarily deploying capital the same way like an Amazon is, where you have AWS, you have Prime, you have all these different things that are coming out now. They like to just bet on one big thing. So in this case, they're going to be betting on metaverse, which we'll see how that plays out over the next couple of years. But these are really the summary points that I think hit it home. So Mohnish says that it's a low risk bet, that it's a 2 times in the next 2 to 3 years, so meaning 2x in the next 2 to 3 years based on its advertising business. Now, after you 2x, you should probably reassess the Reality Labs and how it's doing. I think that this is obviously true. If you're looking into this, base your whole assumptions off of the fact that the advertising business is what you're looking for. You're not looking for the Reality Labs. The great thing is, though, is they have the capital and they have the profits and they have the cash to be able to keep great talent. And Mohnish highlighted this too. Their talent pool is huge. It's very, very deep. They have a lot of knowledge. They have some of the most talented engineers. He also thought that there would be more acquisitions likely. I think so too. They just finished an acquisition. So they just finished an acquisition for a company called Customer, and really what it is it's a CRM, so customer relationship management software platform, and this will help a lot with sort of monetizing and increasing the social aspects of their apps. And then lastly, he's not sure about the metaverse, and I don't think a lot of people really are, because, you know, I know Mark likes to talk it up and, you know, he wants it to be the biggest thing ever, but we'll see really how they monetize it. The whole idea is they're trying to move away from the platform where they don't own the platform. They would like to be the owners of the platform, because right now, if Facebook is, you know, dealing with Google or Facebook's dealing with Apple, there's nothing they can really do as far as a platform goes. And that leads me into my next point, where Google is actually going to be switching their privacy basically similar to Apple. The only difference is they're going to be developing, so basically this key point. The Apple Alphabet-owned company said it's developing a new privacy-focused replacement for its advertising ID, a unique string of characters that identifies the user's device. So basically, Apple made it almost impossible to identify anything. They don't want any targeting ads, but Google doesn't want to do away with this, and Meta actually, and Zuckerberg really, supported this in how they're doing, because they want to focus on privacy, but being able to target ads a lot more efficiently, because it benefits businesses in the end. When you remove the targeting ads, and companies have to spend a lot more for marketing just to kind of get that same sort of customer base every so often, it becomes more of an issue, and companies right now are struggling with that. And it's hit a lot of companies actually on their bottom line and top line, as far as the amount of money that they have to spend on marketing just to get the same amount of customers coming in. And I think that that's a concern. So, but as far as Google, I think Meta in the long term, they'll have some hiccups here and there, but I think that they'll find a new way to sort of target their ads and make sure that their ads are targeting correctly. So I'm not really worried about that in the end. So lastly, let's take a look at the DCF. Let's look at what the intrinsic value, what I think it is at least currently, and then we can end the video. So again, the way that this goes, you have current outstanding shares, revenue, estimated free cash flow, net income, and then obviously these are the ratios currently. So as of Q4 2021, the information that we have, these are the margins that we're looking at, around 33% for both the free cash flow and the net income, which is great because you want to see those kind of be in line. And again, the PE and the price of free cash flow both fall in line. And honestly, at a 14, I think we're starting to hit a point where it's oversold. That doesn't necessarily mean it can't go down further, but if you're going to look into this, I would start doing your due diligence now. So again, the way that this works, you got your worst case, base case, best case, and these numbers are based off of the information you're going to see down below. And you got your revenue growth, just so I can show you a 5% revenue growth, 6% revenue growth, and 7% revenue growth for the next 7 years. If you think they're going to grow up 5%, you're probably crazy, but you know, there's been crazier things that have happened, but I just want to show this as an example. So if you look at the mid, I just used a 6% revenue growth, 32% profit margin, 31% free cash flow margin with a PE and a price of free cash flow of 18. And I did a 15% discount rate. 15%. And you can see here on that base case that we're getting 217 for the net income and 210 for the free cash flow. That's a 15% discount rate. Normally I use 12.5 for when I'm calculating, so let's switch it all back. Normally I use 12.5, and you can see it immediately. It's 245 and 237. 15% just keeps adding in the margin of safety that you'd want. So if I get a fair value with my 15% discount rate at $205, and we're at $207 as of today, I'm gonna start buying. I've been buying on the dip, but if I were getting into this for the first time, I would do my due diligence and see if I come up with the same numbers that I've come up with. I truly think that this thing is beginning to be oversold and more oversold and more oversold, and I'm a happy camper. If I can buy this at cheaper and cheaper prices, that means more returns in the long run. This margin of safety calculation, these are just things that I've added in here. If you want them, I think that the discount rate right now, 15%, gives you a good enough margin of safety. I don't think you necessarily need to pay attention to this. But if you're using something like the WAC or something like that, you might want to go down here, use this 20% margin of safety. Anyways, y'all, I think this is starting to get into, good value territory. Do some due diligence. Let me know what y'all think of Meta and Facebook and just what the metaverse will really end up looking like down below in the comments. I hope to see you next time. I hope this was a good update. Let me know if you want to see more of these. I'm going to try to do some earnings reviews and just different news that I have for all the companies that I own in my portfolio, or at least the ones that I've been trying to get into. But yeah, let me know what y'all think. Have a great day, y'all.